Okay, welcome guys. This is Spiceland Financial Accounting. We are so close to the end. We are on chapter 11, the statement of cash flows. So do you guys remember us talking briefly in 2 previous chapters about the statement of cash flows? A little bit. Remember, the statement of cash flows breaks into the 3 activities: cash inflows and outflows relating to operating activities, investing activities, and financing activities. So we've talked about this in the past, but this chapter totally is linked with the cash flow statement. Operating activities is why the company is in business. Okay? So operating activities for Anoka Ramsey would be instruction. And so any activities related to bringing in tuition, maybe receiving grant money, paying out salaries, maintaining the building, utilities, repairs and maintenance, insurance, all of that's why the company's in business. That is the bulk of the activities, is why the company's in business. Then we've got investing activities. Investing activities only have to do with the purchase and the sale of long-term assets and current investments. So what would that be? The purchase of a building, of a piece of land, the sale of a building, of some heavy equipment, or the purchase or the sale of an investment in another company, not your own company, but in another company. And then lastly, the financing activities have to do with how we fund the operation. The cash inflows and outflows resulting from stock and long-term financing. You guys remember this? Does it kind of bring back a memory a little? So here is the statement. Whoops, why doesn't it? There. Here is the statement that typically you'll see when we're looking at the statement of cash flows. Again, it breaks it into 3 categories. And what we're looking at here is, where does cash come in? Where does cash come out? It's all about the statement of related to cash. Non-cash activities that don't affect cash are not going to be part of this statement. This is a new statement we're going to look at. It's called the Indirect Method, and we start with net income. And then from there, we're going to adjust for operating activities. This indirect method we're going to look at is a little different from the direct method we looked at previously, because the indirect method shows increases and decreases in current assets and current liabilities, which we'll talk about. But the investing and the financing activities, no matter what method you use, will always be the same. So where are we going to, what kind of activities are we dealing with when we deal with cash inflows and cash outflows? So just with a normal company, inflows are going to be related to the sale of goods and services, or the collection of interest and dividends. Now, guys, this is the interest and dividends we are earning, not that we're paying out. This is the interest and dividends we're earning. And then the cash outflows as it relates to operating activities. If you think of Best Buy, or you think of Target or Apple, cash outflows will be for the purchase of inventory, for any operating expenses, administrative expenses, marketing expenses, advertising. For interest we pay out on loans, And then for income taxes, again, think of it, it's why the company's in business. And everybody has a different reason why they're operating. As CPA practice, what I've been doing for the past couple months, I don't sell goods, I just sell a service. So my inflows would be from a service, and my outflows would be for the software, for the wages, for the insurance, for the utilities, for rent. You see, they're common, but they're going to be different no matter what type of company we're talking about. Cash flows from investing activities. Again, what was it? You guys remember what I said? What would be the inflows and the outflows of that, guys? Selling a building, buying land. Perfect. Anyone online? Are you sleeping?
It's basically
No,
anything
right
that's
here.
long term.
No, we're not sleeping.
You guys can speak. Joshua, you start.
Yep, I said anything that involves long-term assets. So sale of building, purchase of a building, sale of land, purchase of land.
Excellent.
FYD like that.
Perfect, guys. Investing, it's very limited. What you would do is you would look at on the balance sheet, the long-term asset section, and really get an idea of any changes, what has occurred between one year to the next. Then financing activities is how a company receives cash to expand, to possibly enhance their various goods and services. Most companies will receive cash from either issuing stock, when you're a company that issues stock, or the issuance of bonds or notes payable. One is an equity, one is a debt. Which one's an equity and which one's a debt?
Is the equity the insurance of stocks?
Correct. Stock is equity. They own the company, don't they? And bonds or notes payable is debt. It's a current benefit that will require a future sacrifice. The future sacrifice is we have to pay back the money, right? Make sense? So those are the inflows of financing, but the outflows of financing would be repaying back debt, or in the case of stock, if the company reacquires its stock out in the market, we call that treasury stock. So that's a cash outflow. And then another cash outflow would be paying dividends to the shareholders. Remember, when we receive dividends because we've invested in a company, that's not going to be financing. What's that going to be, guys? What would it be when we receive dividends because we've invested in a company? Operating activities. Do you guys see that? Yes. But when we pay out dividends to the shareholders of a company, that's going to be financing activities. Now, guys, remember, students sometimes misclassify dividends in preparing the statement of cash flows. Dividends received go into the operating activities, but dividends paid are part of the financing activities. So guys, to start this statement of cash flows, we're going to use our income statement to gain information on the revenues and expenses. We're going to look at the balance sheet and compare one year to the next, and then other accounting records. This slide right here, whoops, this is an important slide. I really encourage you guys to snapshot this or to write this down, because this is really fundamental in understanding where you gain the information for each of these activities. The operating activities, again, is the largest section of the statement of cash flows. And that will come from the revenues and expenses shown in the income statement. But we're also going to use, in this new method we're going to talk about today, the indirect method, the changes in other current assets from one year to the next, and the changes in current liabilities from one year to the next. It's those three items we'll use: the income statement, the changes in current assets and current liabilities, to come up with operating activities. The investing activities, the only thing we'll look at will be the changes in long-term assets to come up with that. And then for financing, we will find in the balance sheet any changes in long-term liabilities, along with the stockholders' equity section, to finalize the financing activity section. Once again, keep this as a helpful tool so you know where you come up with the various items. And in the statement of cash flows, we aren't dealing with non-cash activities. Investing and financing activities, for non-cash activities, when we purchase an automobile by issuing full debt, there has not been any cash involved. Therefore, this would not be included on the statement of cash flows. Any items that do not involve cash are put in notes in the financial statements, but they are not a part of the statement of cash flows. Again, whenever there is an asset acquired by either issuing stock or issuing debt, you're not going to have that a part of the statement of cash flows because it doesn't involve cash. Okay? So here are two methods we know about. The first method is the indirect method that we're talking about this week. The method that we have looked at in the previous, I think, chapters 1 and chapters 4, we talked about the cash flows. We had the direct method. Both methods will produce the same results, but the indirect method is the most common to use, and it is the most economical to use. The direct method actually makes a lot more sense, but it's a little more involved in order to use it. Indirect method, we start with net income. Then we make adjustments to arrive at our operating cash flows. No matter which method we use, the financing section and the investing section are the same. The only portion that's different is the operating section. Questions? Thoughts? Remember, companies choose between the indirect method and the direct method in reporting the operating activities. The indirect method is less costly and is used by most companies. The direct method's more logical, but they're ultimately going to produce the same results. So here's our first exercise. Analysis of an income statement, balance sheet, and additional information from the accounting records of gadgets reveals the following items. So we have a list of 10 items. Indicate in which section of the statement of cash flows each of these items would be reported. Would they be under the operating section, under the investing, or financing? Or would there be a separate note stating it's non-cash? So why don't we take about 3 minutes, and I would like you guys to volunteer to answer them. Okay? If not, I'll call on you, but you can always pass. You know that.
Is the first one an investing activity?
Is the first one an investing activity? How many of you
Or-
think it?
It would be operating.
Operating, yeah, I think operating is right.
Okay,
Not
let's,
long-term.
what is a patent?
It's, oh shoot, it's when. Oh, it's when you like make something yours and nobody else can take
got
from
it.
it or whatever.
You're right, Angel. But usually people purchase these patents. Wouldn't a patent be a long-term asset?
Yeah,
And long-term assets go under which category?
invest.
Investing.
You got it. What about number 2? Why do we use assets? Why do we, like, at this school, we need this building in order to conduct classes, or we need all of this technology in order to sufficiently teach students. At Target, those buildings, the store have all these items in order to store products on the shelving. Why do we have those items, those assets? Wouldn't it be in order to run the business?
Yeah, to operate it.
To operate, operating activities. How about number 3? This is kind of tricky because this is new this week. What increases or decreases accounts receivable?
When people make their payments.
Correct. And they're making their payments, why?
Because they took out a loan or not a loan, but like a note with the people, with
Well,
us.
they're purchasing something, aren't they?
Yeah,
Right? So think about when you're coming to school and you register for a class and you haven't paid for it yet, logically, the school increases their accounts receivable because you owe the school money. But what is your accounts receivable is basically income to the school, isn't it?
mhm,
Make sense?
yeah.
So that's part of operating. What about number 4, guys? Financing. Financing because we're borrowing money for whatever purpose to expand. What about number 5?
Operating.
Operating. We sell inventory because that is the purpose of the business. What about 6? Investing. Excellent. What about 7?
I
Investing?
think also investing.
Excellent. What about 8? And this is tricky. 8's kind of tricky. It's tricky. And it's, okay, here's the key. The word,
Financing?
I'm sorry,
Oh, I'm sorry. I said financing.
exchange of a long-term asset. This one shows cash was not handled. We took one asset and exchanged it for another. Since cash isn't involved, wouldn't this be a non-cash activity?
Yes.
Mhm. It wouldn't be part of the statement of stockholders' equity. What about a decrease in accounts payable? Let's think about this. Why do we have accounts payable?
It's a liability.
It's a liability because we owe somebody something. So we could have a salaries payable. We could have utilities payable. We could have supplies payable, which would be an accounts payable. So usually we have an accounts payable because we owe somebody something as a result of operating the business, right? Such as salaries, we pay to employees. Accounts payable could be paying insurance, paying rent, paying for repairs. So any decrease or increase in accounts payable has to do with operating, the reason the company's in business. Okay. What about number 10, guys? The payment of dividends. Financing, excellent. What would be the receipt of dividends?
Could it be investing?
If we receive dividends, it would be operating because that's why we're in business, is to invest in other companies and we receive dividends. But when we pay out dividends, you guys are exactly right. It's financing. Okay, here's a question for you. Which of the following would be included in the operating activity section of a statement of cash flows? A, sale of a piece of equipment. B, payment of dividends. C, increase in the balance of accounts payable. Or D, issuance of common stock.
Is it A?
Let's talk these through, guys. When
Is it
we,
C?
is it what?
C.
You got it. But let's
Oh.
talk about why it wouldn't be A. When we sell a piece of equipment, what is equipment? A long-term asset.
The asset,
Correct.
And wouldn't that go under investing?
yep.
Yep,
Yeah.
that's my mistake.
It's okay. Hey, that's how we learn. Okay. What about payment? I'm sure not beating you up. I appreciate you taking the effort to, be a part of this. What
Oh,
about,
yes, absolutely.
what about payment of dividends? Financing. Increasing the accounts payable balance is why we're doing business. We have bills to pay. And what would issuance of common stock be?
Financing.
Perfect, guys. Changes in current assets and current liabilities would be located in the operating activity section of a statement of cash flows. The sale of equipment would be in the investing activity section. The payment of dividends and issuance of stock would be in the financing section. Is it kind of clicking? Kind of? Okay. So now we're going to get into how we go about gathering the information to prepare the statement of cash flows. The first step we're going to do is the operating activity section. Then we'll do the investing section. Then we'll do the financing section. Then lastly, we'll just combine it all and see our cash from the previous year based on the changes this year to come up with our ending cash balance. So here you see e-games, which guys, excuse me, I just got to fix this. Okay, so here you see e-games, and here's the income statement. It shows our sales and it shows our expenses along with our net income. Sorry, guys. I didn't catch those. Okay, here's the balance sheet. Do you see the balance sheet has a comparative balance sheet based on the 2021 assets and liability, or this one's just the assets versus 2022. And what you see is the increase or decrease in these categories from one year to the next. So we see that at the beginning of 2022 or at the end of 2021, we had 48,000 in cash. But at the end of 2022, we have 62,000 in cash. So our statement of cash flows is going to show that our cash increased 14,000 during the year. Then you see the change in accounts receivable. It went from 20,000 to 27,000 from one year to the next, which means accounts receivable increased 7,000. Our inventory went from 45,000 to 35,000. It decreased from one year to the next. And our prepaid rent increased from one year to the next. So we know these current assets, not the cash, but everything else we'll use to compute the operating activity section. Our investments increased from 0 to 35,000. The land decreased from 80 to 70. And the equipment increased from 70 to 90. These three items here, the long-term assets, will affect what section of the statement of cash flows? Long-term assets are going to affect investing. Here we have the liabilities and stockholders' equity section. Our liabilities, accounts payable went from 27 to 22. They decreased 5,000. Our interest payable went from 1,000 to 2,000. So it increased 1,000. And then our income tax payable decreased 2,000 from 7,000 to 5,000. This is going to be a part of our operating activity section because they're current liabilities. We've then got our notes payable, our long-term liability increased 20,000, and then our stockholders equity section. Okay. This is the information we need to prepare the statement of cash flows. Then we also have some additional information. It tells us we purchased stock in Nintendo Corp for 35,000. So when we purchase an investment, that's going to be investing, right? When we sell land originally costing 10 for only 6, what is the category would the sale of land be? Investing. When we purchased 20,000 in equipment By issuing a $20,000 note payable due in 3 years, and look at what they tell you, no cash was exchanged in the transaction. Non-cash, excellent. When we issued common stock for 5,000 cash, what does common stock fall under? Financing. And then when we declared and paid a cash dividend of 12,000, what does that fall under? Excellent. Questions on this, guys? Do you understand these various categories and what we just talked about? So we start with our net income, the 42,000 net income. And then from there, we are going to adjust the operating activity section, the investing, and the financing. We know here we have an increase in cash of 14,000. We show our cash at the beginning of the period, which will end up giving us our cash at the end of the period. So we take that information from the income statement and from the changes in current assets and current liabilities in order to arrive at the changes in operating section. We have to remove the non-cash activities. Non-cash, think about it, guys. When we show depreciation expense in the income statement, doesn't depreciation expense remove or reduce our net income? But since it's a non-cash event, we're going to add that back to derive cash flows. Remember, any gains and losses we see on the income statement really affects investing activities. So we're going to remove that also in order to just get to the operating activity section. Then we're going to take any changes in accounts receivable or current assets and current liabilities and adjust them. So when there's an increase in an accounts receivable, think about it. An increase in an accounts receivable means there's more sales, but we haven't collected the cash on it yet. So our net income looks higher, but it's not from receiving cash. So in that particular case, when we have an increase in accounts receivable, we're going to have to subtract that in order to derive at our cash balance. Let's look at this example. Hardware Suppliers reports net income of 165,000. Included in that net income is a gain on the sale of land of 20,000. A comparison of this year's and last year's balance sheets reveals an increase in accounts receivable of 35,000, an increase in inventory of 20,000, and a decrease in accounts payable of 55,000. Prepare the operating activities section of the statement of cash flows using the indirect method. So I'm going to give you a couple minutes. Think this one through. We're starting with net income, and then we're going to make some adjustments. Okay? You want a little more time? How you doing, guys? Any input from online? Anyone willing to participate? Help out? What are we going to start with? We're going to start with our net income. Oops, let me fix this. Sorry, guys. We're going to start with our net income of 165,000. We're going to adjust and get rid of the gain on the sale of land because it's not part of operating. So we'll subtract that gain. Because if you think about it, that gain increased our net income. But since that gain isn't related to operating activities, we're going to subtract it. We're going to subtract our increase in accounts receivable. If you think about it, that increase in accounts receivable increased our sales, but it didn't have to do with cash. The increase in accounts receivable means they owe us the money. So in order to adjust to get to cash, we're going to subtract that. An increase in inventory, we're going to subtract to get to cash because we use that money to purchase inventory. And when we decreased our accounts payable, we used cash to decrease that accounts payable, so we're going to subtract that. So our net income minus the gain on the land, we'll subtract the increase in receivables, we'll subtract the increase in inventory, and we'll subtract the decrease in accounts payable to arrive at net cash flows of 35,000. Now, what the book is trying to, or the authors are trying to explain is, this is a little goofy that they showed net income of 165, and yet all of these events didn't have any cash pertaining to it, which means it could be possible, or it could be management's trying to use a tactic to boost their revenues, since cash was not involved in any of that. It's a little fishy. Questions? Thoughts? Comments? Okay, guys, which of the following would be included as an adjustment to net income in the operating activity section of a statement of cash flows using the indirect method? Would it be depreciation expense? Would it be, bless you, purchase of a truck? Issuance of common stock? Or payment of cash dividends? What do you guys think? I'm sorry, what is it? A, depreciation expense. Excellent. We would add back the depreciation expense because this is a non-cash item. So in the operating activities section, we'll adjust our net income for items such as depreciation or amortization that did not involve cash. We will add back the loss on assets or subtract the gain on assets, since this does not affect operating activities. Then we'll adjust with the current assets and we'll adjust with the current liabilities to arrive at net cash flows from operating activities. Right? Guys, this is a really important slide too to have in your notes, because this will assist you in really understanding or knowing the process to fill out the operating activity section. So eGames reports net income of $42,000. And it also reports depreciation expense of $9,000 in its income statement. So the first thing we'll do is come up with our net income. Our net income is $42,000. And then we'll add back our depreciation expense since it's a non-cash item. Then it tells us that eGames sold land originally costing 10 for only 6, resulting in a $4,000 loss on the sale of land. So what are we going to do here? We're going to add back this loss since it doesn't have to do with the operating activity section. Okay. Sometimes students are unsure whether to add or subtract a loss on the sale of an asset. Remember, a loss is like an expense. They both reduce net income. Treat a loss on the sale of an asset like depreciation expense and add it back to net income. Whereas a gain on the sale of long-term assets is the opposite of an expense. So we subtract it from net income to arrive at net cash flows from operating activities. Then, in order to arrive at net operating cash flows, we will subtract an increase in a current asset, and we will add back a decrease in a current asset. And then in regards to liabilities, we're going to follow the pattern. We're going to increase an increase in a current liability, and we're going to decrease a decrease in a current liability. And again, guys, just write these down so you know that the current assets, you do the opposite of what's happening to the current asset. The current liabilities, you follow the increase and the decrease accordingly. So when eGames accounts receivable increased $7,000 during the year, are we going to add that back or subtract it? What do you think, Amon?
Would you add it back in?
You would add it back. No, excuse me. I'm sorry. You would subtract it. You would do the opposite. Current assets, you do the opposite that the flow happens with. Current liabilities, you follow the same direction. So in this case, if accounts receivable increased, we're going to subtract it. And think of it like this. That increase in accounts receivable means there were more sales, but we haven't gotten paid on it. So the reason we're going to subtract it is to get to our statement of cash flows. What cash really came in. Okay, so we're going to subtract that. Now, what about this one? If the inventory balance, which is an asset, decreased by 12,000 during the year, are we going to add that back or subtract it? Add it back. We're going to add back that decrease. What about this one? E-Games prepaid rent, an asset, increased $2,000 during the year. If a current asset increases, what are we going to do? Subtract it. Are you guys getting the drift of what we're doing here? How's it going, Angel? E-Games accounts payable decreased 5,000 during the year. When a current liability decreases, we follow that pattern, right? And we're going to decrease it, subtract it. How about this one, Joshua? What do you want to take us on this one? E-Games interest payable increased 1,000 during the year.
Let's see, you said the e-games had an increase of, I'm sorry, what was that again?
E-Games interest payable, I'm reading right here from the screen. E-Games interest payable increased 1,000 during the year. If a current liability increases, what will we do in the operating section? Will
In
we,
the operating, would you add it back?
you would add it back. Excellent.
Okay.
Guys, you always know you can pass, okay? If I call on you and you're uncomfortable, you can pass. E-Games income tax payable decreased 2,000 during the year. What are we going to do? We're going to subtract it. Guys, sometimes these exercises can seem monotonous, but honestly, there is no other way to learn this material than to do the problem over and over. There's just no other way. We're going to subtract it. After all these adjustments, we take our net income and we add and subtract all these items to get to our net cash flows from operating activities of 50,000. Questions? Comments? Thoughts? Using the indirect method, remember, we start with net income and adjust this number for revenue and expense items that do not affect cash, gains and losses that do not affect operating cash flows, and then changes in current assets and current liabilities. Okay, guys, portions of the financial statement for Peach Computer are shown below. So this is the income statement. Then it says, this slide here is a balance sheet showing 2 years. And again, sorry guys. Oops. 2033 will be here before we know it, though. And so here's our balance sheet showing 21 and 22 and the increase or decrease between the first year to the second year. Our job is now to prepare an operating activity section of the statement of cash flows using the indirect method. So the very first thing we're going to do, guys, is what? What do we start with? Net income, 130,000. We start with our net income.
We can't see the screen.
You can't.
Yeah, it's been like this for like 10 minutes.
Guys, I'm so sorry. Can you see it now?
Yeah.
Yep, I
Yeah.
can see it now.
Yeah.
Thank
I
you.
must have clicked the pause share. I'm so sorry. No wonder Joshua was asking me what the form said. You guys, you'll have to tell me if I do that again. I apologize.
I
No
thought it
worries.
was my phone.
No, it wasn't your phone. It was me. It was the operator error.
Okay.
Sorry.
No, that's fine.
Okay, so we start with net income. Then from there, we adjust for depreciation. With depreciation, we add it back since it's a non-cash activity. If we had a gain or loss, we would adjust that since that gain or loss doesn't entail operating activities. Then accounts receivable decrease. When it's a decrease in a receivable, we add it. When it's an increase in a current asset, we subtract it. You see, here's a decrease in prepaid rent, we add it. But then in regards to our current liabilities, we're going to follow suit. So increase in accounts payable, we'll add it. A decrease in income tax payable will subtract it in order to come to our net cash flows from operating activities. Make sense? I bet it helps now that you can see the screen. Sorry, guys. Okay. How about this one, guys? Which of the following items would be added back to net income in the operating activity section of a statement of cash flows using the indirect method? A gain on the sale of a piece of equipment? Would we add that or would we subtract that, guys? We'd subtract it. The payment of dividends, that doesn't go in the operating section. Where does that go? Financing. An increase in the accounts payable. With current liabilities, don't we follow suit? So we would be adding that back. But the question is, which of the following would be added back? C, right? Make sense?
Yep.
Now, the next two sections are identical to the direct method. Investing activities, we have increases or decreases in investments. So when we have an increase or decrease in property, plant, equipment, or intangible assets such as that patent, what's another intangible asset we've talked about? What else? See, you guys are lucky online. I don't have to look at you in the eyes and you have to avoid me. What's another type of intangible? Trademarks? Right?
Could copyright be one?
Copyrights? How about goodwill? Remember, that's a big one. Goodwill, when you someone purchases another company and the price is over the assets, Then there's an intangible asset called goodwill. They're willing to pay for it due to lots of reasons. Existence in the business, their good name. McDonald's. People spend a lot more on the McDonald's than just the assets. Right? So these items, increases or decreases in long-term assets, are going to be a part of the investing activity. So when eGames purchased investments for $35,000 cash, sold land originally costing $10,000 for only $6,000 cash, and purchased $20,000 in equipment by issuing a $20,000 note payable due in 3 years, where there was not cash exchanged. So right away, when we know there wasn't cash exchanged, is it going to be part of the statement of cash flows? Aman, is it going to be part of statement of cash flows?
I don't know.
That's okay. Sometimes I don't know either, Aman. Today I had a lot of sleep, so I'm feeling pretty good. Christina, will it be part of cash? It's not going to be, because it wasn't involving cash, okay? So what we'll do here, when we purchased equipment, we're going to subtract that. That was using cash. 35,000, we're using up cash, we're subtracting it. When we sold land for 6, did we receive cash or did we use cash? Did we receive cash or did we use cash, guys?
We received it.
We received it. Excellent. Then the number 3, of course, it's not involving cash, so we're not going to include it in here. We might make a note in the statement, financial statements, but we don't have to include it in here at all, do we? Does this make sense, guys? Kind of. What I'm trying to do, honestly, this can be really a tough chapter. I'm trying to break it down and make it simple. I really am. And sometimes the best way to make it simple is to kind of give you hints or like helpful tips in order to make sense of. Financing activities are figured out by examining the changes in long-term liabilities and in stockholders' equity accounts from the balance sheet. So cash transactions with a company's creditors and shareholders are what we're going to look at in regard to financing activities. So when eGames issued common stock for $5,000 cash, and they paid a cash dividend of $12,000, we're going to add the common stock because we got cash from that. We're going to subtract the dividend because we paid out cash for that, didn't we? So our net cash flows from financing activities is a minus 7,000. That makes sense? Most investing activities can be explained by changes in long-term asset accounts. Most financing activities can be explained by changes in long-term liability and stockholders' equity accounts. Okay. Look at this one. Which of the following would be included in the investing activity section of a statement of cash flows? The sale of a piece of equipment, the payment of dividends, the increase in the balance in accounts payable, or depreciation expense.
Is it A?
Is it A? I say it's A. You guys agree? Yes. Changes in long-term assets like equipment would be included in the investing activity section of the statement of cash flows. Which of the following would be included in the financing activity section of a statement of cash flows?
Is it B?
Is it B? Payment of dividends is exactly right. Excellent. Dividends received would be part of the operating activity section, wouldn't they? So here, we finally have a completed statement of cash flow section. We start with net income. We make all those adjustments to get to operating activities. And then the investing and financing are pretty straightforward. Usually there's not a lot associated with each one. We have the net increase or decrease in cash for the period. We show our beginning cash at the beginning of the period to come up with our cash at the end of the period. Make sense? Guys, is it jiving? Is it coming together? Next, the financial analysis, you guys will go through that on your own because next week we're going to go through all of them, the various ratios. Then the last portion is to talk about the direct method. Now, we talked about this direct method in previous chapters, but we're just going to be refreshed on how this direct method works. We report inflows and outflows directly. Okay. Got it? So we are going to convert each revenue and expense item to its cash basis amount. And items that don't have cash effect don't get reported. So inflows regarding to operating activities would be cash received from customers, cash received from interest, and cash received from dividends. The outflows would be cash paid to suppliers, cash paid for operating expenses, cash paid for interest and for income taxes. Okay. So prepare the operating section of the statement of cash flows for Peach Computer using the direct method. Now, guys, this slide is really critical for you. Let me tell you why. In order to derive cash received from customers, this slide tells you how to do it. You take the net sales and you add a decrease in accounts receivable, or you subtract an increase in accounts receivable to get cash received from customers. For cost of goods sold, to get to cash paid to suppliers, you're going to add an increase in inventory, or you would subtract a decrease in inventory. That comes up to purchases. The increase in accounts payable, you'd subtract, or you would add the decrease in accounts payable. That gets you to cash paid to suppliers. Operating expenses minus your decrease in prepaid rent gets you to cash paid for operating expenses. And then your income tax expense plus your decrease in income tax payable, or minus your minus your increase in income tax payable gets you to the cash paid. Please know this slide is critical in doing some of your homework and quiz. You need this to know how to get to those various cash items. So this is our cash received from customers, our cash paid to suppliers, our cash paid for operating expenses, our cash paid for income taxes to get us to cash flows. Okay. Which of the following sections of the statement of cash flows will be different depending on which method is chosen to prepare it? The operating activities, investing, financing, or all sections? A, operating. Okay, let's look at the homework. Okay. Any questions before we do that?